So in this video today, I wanted to talk about how whole life or cash value whole life insurance works. So as you can see on the screen already, it starts with a base premium. A base premium is what keeps the policy going, especially long term. It is the core of the actual policy. But when you're doing high cash value whole life, it's not the only portion to the policy. So some of what you have seen in the past from some insurance agents with these whole life policies is just all base premium. If you pay $1,000, let's just say a year, $1,000, and you have almost no cash value in the first 3, 4, 5, 6, 7 years, whatever it is, you don't have a lot of cash value for very long or right up front. So with high cash value, we add something else that is called paid additions. So paid up additions is a rider. It's just an add-on that you use in order to enhance the policy. So whenever you put money into this portion, they do have a small fee, but the majority of it is cash value. So and there's different reasons to use different amounts in the base as opposed to the paid up additions. Long term, beyond 10 years, the base premium will produce, with a lot of insurance companies, not all, but a lot of insurance companies will produce more dividend. And these companies that you utilize this with in general, with this whole concept of being, building your own bank or being the bank is they need to be participating whole life dividend paying policies. That with the participating, what that means is that the policyholders are the actual owners or shareholders of the insurance company. So if they have hundreds of thousands of insurance policies, each one of those people has a proportionate share based on how much they pay into their policy. That's one thing. Two, the dividends. So with other ones that are non-participating, they might still pay you typically, like say, a guaranteed rate of say 3%, and that's before expenses. There is a cost of insurance, okay? But whenever you have these participating whole life policies, you get that guaranteed amount, whether it's 3% or 3.75. It depends on the insurance company. Some of them are even as low as 2. But you have a portion that is declared profit of the money that was taken in revenue of that insurance company, and of that portion of profits that they deem is a dividend, that gets paid out too. So say your dividend rate is 5.65 and you have a guaranteed rate of 3, well, you get another 2.65% on your money. Typically in that scenario, depending on how it's structured, you could probably yield about 3 to 4%, depending on the insurance company, depending on the structure of the policy. And in the later years, that's not as significant whenever you actually look at the illustrations, but it's still, for a lot of people, that's still a metric that they keep in their mind. So you can say you get into a crunch and that base premium is the lesser amount of the two of these. So you have your paid up additions, which is the bulk of your money in many cases. It may be 60% or more. And the base premium is the remainder. Well, that base premium is what can keep it going. So if you get into a crunch and you can't pay it, there's a number of things you can do. One, you already have cash value normally in your policy of some sort. You can have it, it's usually set up this way, if nobody changes the options on how the policy is set up. It normally does what's called an automatic policy loan. This will pay the base premium. So that will pay it, and it will take a loan from the available funds and the cash value, and it will pay that premium. So now you're paid up for, say, the year. The other way you can do it is you can obviously pay it out of pocket, or you can also, in a pinch, if you're beyond year 7 realistically, so it doesn't become a modified endowment contract, which a modified endowment contract, still a life insurance policy, but now it's taxable. So in order to avoid that, ideally this would be after year 7 in most cases, and you could do what's called a reduced paid up, which that means is that basically you're purchasing that amount of insurance that you, with the cash value that's in your policy, whatever death benefit that buys, it is bought and it is done, and you don't have to put another penny into that policy. But the downside is you can't put any more money into the policy for growth purposes. So with the reduced paid up, now you have no more cost of insurance because you've already paid it. It's done. So all you get is your dividends and growth going forward. So there's upsides and downsides to it. Yes, it yields you a little higher return, but you can't put any more money into it. So realistically, to be able to pay into it long term, because every year you will receive more than the year before based on your premium being paid. So you wouldn't want to stop paying on that, in my opinion. Why would you? Why would you want to? Anyway, so these are the two parts of the policy. It can get a little more complicated under paid up additions. There are term riders and blended term riders. Well, let me say blended term riders, not a term rider, but a blended term rider also kind of falls into the paid up additions category, because a portion of what you pay into that goes into paid up additions. And what it does is it buys down the term. So as you go, it's buying more paid up additions, and it's getting you closer to the death benefit that you had to set in order to fund it the way it was set up. It actually accelerates the policy, and you end up with more cash value overall, believe it or not. People are like, why would I add the extra expense? It's not, in the end, it's really not an expense, and you actually benefit from having those riders on there. But, you know, some people look at just a pure term rider as an expense. But if you're able to fund it more heavily because of that term rider, I think it's, you know, in my opinion, it's going to be more worth it, especially if you look at the numbers. But aside from that, there are so many uses, as you can see in some of my other videos, for the insurance policies. But I wanted to explain how this works, because some people don't understand it. Some people aren't even sure why. But, you know, in general, you're looking at the combination of these two has a yield of whatever the percentage rate is. So, you know, if it's, you know, let's just say it's 6%, could be 6%, probably depends on the company. I only know of one that's really up there. But if it was 6%, and that's before cost, but your net is still, say, 4, I mean, more than worth it, in my opinion, because you can access this money tax-free. And the death benefit is typically, it's income tax-free. Now, if you have a big enough estate, depending on your state, it could, if it's included, and it depends on your legacy planning or your estate planning, how that's set up. If there's trusts, if there's, you know, maybe there's a life insurance trust, maybe there's not, maybe it's a living revocable trust, and there's a number of things that could go into the estate planning, but just those are just examples. But that would help avoid, potential taxes in those situations. Again, it's all in the planning. It's all in how it's done. And some people even take out life insurance policies just to cover the estate taxes. So, but that has to be a pretty big estate. But anyway, I'm getting way off the subject. But in these scenarios, say that 4% is the internal rate of return. Some people get really into the internal rate of return. I've talked about this before. My policies, the past year that I just paid of the annual base premium on just one of my policies. Now, mind you, this particular policy is like 13 going on 14 years old. It paid out, or the increase in cash value, when I paid the $3,409, the increase, or what I had available to me, was $8,000. So you could see why I could care less about this other number, because I more than doubled my money. I mean, 6,800 would have been, 6,800 and change would have been double my money. But I got an additional, let's just say, $1,200 on top of that. So, we're almost talking about, 2.5 times my money, roughly, give or take. I'll do that all day long. Even in retirement, I'll do that, because I'm more than doubling my money. And by the time I hit retirement, I'm probably a good 10 or 15 years. I don't know. I mean, yeah, probably, I say 10 or 15, just depending on what you consider retirement. But it will be a higher multiple than that by the time I get there. So these things work quite nicely. If you'd like to see some samples of what they would look like, click the links down in the description. Get on my calendar. We'll discuss what you're looking for, and then I will go and model that for you, and then we'll go over it, and I'll show you what that looks like. Please like, subscribe, click that little bell down there, and I will catch you on the next one.